Hi there, and thank you for joining us for this episode of PhillipCapital's Market Watch. I'm Zain, a senior research analyst from Phillip Securities Research. In today's episode, we will be taking a closer look at market trends during US midterm elections and the impact on markets, given different scenarios. Let's dive right in. Midterm elections are general elections held every 4 years, exactly 2 years after a presidential election. It serves as a pulse check on the current administration, often shifting the balance of power in Washington. While the presidency is not on the ballot, all 435 seats in the House of Representatives and approximately one-third of the 100 Senate seats are up for election. Midterm elections have the potential for a shift in congressional control. Should the opposition party gain control of either the House or the Senate, it can lead to a divided government. The president may find it difficult to pass major legislation, confirm judicial nominees, or set budget priorities. In addition, a change in House control often leads to increased oversight and investigations into the executive branch, as the new majority power gains subpoena power. Let's begin by looking at how the S&P 500 historically performs during midterm election years compared to other years in the presidential cycle. We can see that midterm years are historically the weakest for the market, with an average annual return of 3.6% during these years. This is below the average of 5.4% in post-election years, 10.9% in election years, and 13.3% in pre-election years, which tends to be the best performing in the 4-year presidential cycle. Next up, this chart shows the S&P 500's monthly seasonality in midterm election years. We can see that the market dislikes the uncertainty leading up to the election, historically showing a weak performance before the final quarter of the year. The weakness tends to be pronounced in the months of May, June, and September, where monthly returns typically decline between 0.7% and 1.1%, and with a less than 50% probability of gains. However, once the election uncertainty clears, it tends to trigger a relief rally in the final quarter of the year. From October to December, the S&P 500 historically rises between 1.1% and 2.1% on a monthly basis, with a 65% probability of gains. Now, let's look at how different midterm election results impact markets. This chart shows the impact of congressional control changes, whether House or Senate, on the following year's S&P 500 returns. We can see that the market has historically performed better when the existing legislative balance is maintained, with the S&P 500 returning an average of 18.1% compared to the 15.4% when there's changes in congressional control. This could be due to the market preferring stability and continuity in policy, tax regimes, and regulatory environment. Let's now compare the impact of a unified versus divided government on the following year's S&P 500 returns. We can see that the market has historically performed better in the case of a unified government, where the presidency and Congress belong to the same party, with the following year's S&P 500 returning 18.8%. This is slightly higher than the 15.4% in the case of a divided government. While gridlock theory suggests a divided government could be preferable to prevent drastic policy changes, this data shows the market has a slightly more muted response. One possible reason is that markets could have priced in the adjustment period for new community leadership and legislative priorities. The market can also perform better when a single party has a clear mandate to pass legislation. To conclude, the S&P 500 tends to underperform in the midterm election years in the 4-year presidential cycle, with an average return of 3.6%. Secondly, shifts in congressional control often results in a divided government, with only 5 cases of a unified government in the last 20 midterm elections. Thirdly, strong double-digit returns in a year following midterm elections, regardless of partisan outcome, remains a reliable historical trend, in the 4-year presidential cycle. This aligns well with the strong pre-election year seasonality discussed earlier. Lastly, we tend to see stronger market performance in cases of a unified government or no changes in congressional control. With that, this brings us to the end of this episode of PhillipCapital's Market Watch. I hope the insights shared today will be beneficial for your investment journey. Remember to like, share and subscribe, and follow us on our socials. Thank you and see you next time.